Welcome back to Options Trading for Beginners. In our first 7 videos, we've covered the core building blocks of options trading, from what calls and puts are, to the factors that make up their premium, the details of a contract, and the role of the Greeks. Today, we're going to introduce a powerful tool that helps us visualize the exact risk and reward of any options position, the payoff diagram. Think of a payoff diagram as a roadmap for your trade. It's a graph that visually represents the profit or loss of an options position at different prices of the underlying stock. It allows you to see in an instant your maximum potential profit, your maximum potential loss, and your break-even point. This is the foundation for understanding and analyzing every strategy we will cover in the rest of this series. Payoff diagram has 2 main axes. The vertical axis, or the y-axis, represents your profit or loss. Anything above the horizontal line is a profit, anything below is a loss. The horizontal axis, or the x-axis, represents the price of the underlying stock on the expiration date of the option contract. Let's start with a simple example that's not an option at all. Buying 1 share of stock. If you buy stock at $50 a share, your profit goes up dollar for dollar as the stock price rises. If the stock price falls, your losses also increase dollar for dollar. The payoff diagram for a long stock position is a straight line that passes through your purchase price. The point where you neither make nor lose money is your break-even point, which for a long stock position is simply the purchase price, in this case $50. Your profit is unlimited, but your potential loss is also significant, down to the stock price going to zero. Let's look at this with 2 simple examples. If the stock price drops to $40, you would be at a loss of $10 per share. Conversely, if the stock price rises to $75, you would have a profit of $25 per share. Now let's apply this to options, starting with a long call option. Remember, a long call gives you the right to buy stock at a specific strike price. Let's say you buy a call with a $50 strike price or a premium of $2. The most you can lose is the premium you paid, which is $2. With payoff diagram, your loss line is a flat line at -2. It doesn't matter how low the stock price goes, your loss is capped. At a stock price of exactly 50, your option has no intrinsic value and you are still at a $2 loss. Every dollar the stock price goes above the strike price, your profit starts to offset the premium you paid. The point where the stock price has risen enough to fully cover the premium is your break-even point. In this example, your break-even is 50 plus 2 or $52. Above 52, every dollar the stock price increases becomes pure profit. For example, if the stock price rises to $75, your option has $25 intrinsic value. After subtracting the $2 you paid for the premium, your net profit is $23. Whilst this is less profit than if you had simply bought 1 share of the stock outright, your key advantage is that your downside was strictly limited to the initial $2 you paid. Next, let's look at a long put option. A long put gives you the right to sell a stock at a specific strike price. Say you buy a put with a $50 strike price or a premium of $3. Your maximum loss is still the $3 premium. So your loss line is flat at -3 on the diagram. Your profit begins when the stock price falls below your break-even point, which is the strike price minus the premium. In this case, your break-even is 50 minus 3 or 47. Every dollar the stock price falls below 47, your profit increases by $1. The diagram shows your profit increasing as the stock price falls, with your maximum profit occurring if the stock price goes to zero. Your loss is always limited. Finally, let's look at the other side of the trade, selling options. Payoff diagram for a seller is a mirror image the diagram for the buyer. Makes perfect sense. Your profit is the buyer's loss, and your loss is the buyer's potential profit. Remember, when you sell an option, you collect a premium, take on an obligation. You sell a call option with a $50 strike and collect a $2 premium. Your profit is limited to that $2 premium. Payoff diagram is a flat line at a profit of $2 as long as the stock price is below 50. Break even is the strike price plus the premium collected, or 52. If the stock price rises above $52, your losses start to accumulate and are theoretically unlimited. The diagram clearly shows your limited profit and unlimited risk. Payoff diagrams are the visual language of options trading. They are simple, elegant, and provide a clear picture of what you stand to gain and what you stand to lose. They allow you to move beyond simply looking at a trade as bullish or bearish, and instead to truly understand the precise risk and reward profile you are taking on. In our next video, we will use this powerful tool to explore our first set of practical strategies and dive into the risks and rewards of being a contract seller. Make sure you're subscribed so you don't miss it. Thanks for watching, and I'll see you there.